My name is Ed Pulkstenis. I have about 30 years in the insurance business, working almost totally with insurance carriers or for insurance carriers. I started as an actuary in the business. An actuary is a very technical role. It's a quantitative, mathematical-oriented role where we use a lot of data, a lot of past data, especially to predict the future within an insurance company. That helps us predict what the insurance company liabilities would be in the future. It also helps us determine pricing. And I did that work for about 12 years or so. And then I had the opportunity within the company where I worked to move over to the underwriting side and start up a small business operation. Now, that was right in the days when agents were starting to use the internet to submit business. It was also when some new pricing models, a new technology called predictive modeling, was starting to be used in the insurance business. And predictive modeling is a very advanced way of pricing business based on individual risk characteristics. So for me, coming as an actuary over to the underwriting side, it was a perfect stepping stone to be able to get into underwriting. From there, I moved on to become a chief underwriting officer, and I served in that role for a couple of different companies. And over the last 6 years, I've really worked primarily with startup insurance companies, and that's been a lot of fun. These are companies that are just starting up from scratch. They are companies typically that want to offer something new in terms of the products or in terms of the services, or perhaps they want to offer a new user experience using recent advances in data and technology to deliver their value proposition. Let's talk about product development. Over the course of my career, I've had the opportunity to be involved in many different types of product development. One aspect of product development involves existing products. So these are products which are in the market, which are generating premium, and which are generating results. They may be successful, they may be unsuccessful, they may be growing or not growing, they may be profitable or not profitable. And so product development in that context really involves looking at the way the product is performing and understanding what we can do to make that performance better. In order to do that, we need data. We need data from the technology systems and from our underwriting systems to understand the types of business that we're writing. We also want to look at claims activity, and we want to try to correlate that claims activity in with that business that is on the books. So we're interested in claims frequency. As we write business with these different characteristics, where do we see claims occurring? Then we're also interested in the claims severity. Claims severity involves how big these claims are when they occur. So for example, we might see a lot of large fire losses, and those could be what's driving unprofitability of a book of business. And so as we go into the product development function, we would look at changing the pricing or changing the underwriting appetite or changing the product terms to be able to reduce those fire losses or be able to address those fire losses in some way to continue to have a profitable and long-term sustainable product that we can offer to the marketplace. Now, I do a lot of work with startups, and so in a startup environment, we are often building products from scratch. There is no existing portfolio. And so in that world, we really need a starting place. And we typically start with an organization called ISO. ISO is an industry organization that collects data from most companies and uses that data to create loss costs, which are a component of the rates. They also use that data to create policy forms and a system of rules that dictate how the policy forms interact with one another and how those loss costs, or once they're turned into rates, how those rates should be applied. And so with all of that data, they then distribute that or share that back out with companies that want to use it. And in a startup environment, that's a very valuable starting point to be able to work with. There are really two categories of product. There are admitted products, which are products which we need to create and then file with state regulators. Insurance is regulated within each state, and so with admitted products, we create the product and we submit that product to a state regulator, and then we get their approval. In some cases, we may need to wait for their approval before we can deploy it, or in other cases, some states do allow you to start to move forward with that product prior to a formal approval. But either way, as we build that product out, we need to be conscious of the fact that there are regulators looking at it. They might ask for changes. And if they do ask for changes, we need to be prepared to build those changes into the product. The other category of product that we actually do a lot of work on in the startup world are non-admitted products. Non-admitted products are products that are typically offered to customers who are not able to get coverage in the admitted marketplace. These are customers who might be very highly specialized customers, or they might have particular risk characteristics that are very challenging, or they might have a degree of claim activity that is not well managed in the admitted marketplace. And so in those cases, the regulatory system allows those products to be offered on a non-admitted basis, which allows companies to provide more flexibility in the rates and more flexibility in the terms to be able to create the right coverage for those more specialized customers or customers who have more specialized needs. Either way, whether we're working on admitted products or non-admitted products, we're going to need to build that product into our technology, into a technology system that's going to allow us to offer that product and execute that product all the way through to delivering a policy. We need an ability to rate it, we need an ability to provide quotes, and we need an ability to provide ultimately that policy which is going to go to the customer. Let's talk about underwriting. Underwriting is really the central function that involves an insurance company looking at the business that's coming in and making decisions about that business, making decisions about which risks they want to put their assets up against to be able to provide protection, to be able to provide them with coverage. A lot of what I do involves that underwriting activity. And so, it really starts with fundamental underwriting principles. Companies want to understand what activities a risk is involved in, and they want to understand also if there are any fringe activities, maybe activities that a risk is only incidentally involved in, but which could represent higher hazard. Another example of something they'd want to understand would be the quality of the management team. And so you might see questions from time to time from companies where they might ask, how long has the company been in business? Or what is the experience of the management team that runs a particular company? If they run a good shop, that tells you something about the insurance risk that account represents. We bring that data in through technology, and that data is not perfect. Data often has challenges with it by itself. Data can be missing. It can be sometimes inaccurate. And so when we go out and we look at data, we bring that in, but it's not the only source of truth that we have. We're really looking at that as one source of information that helps us triangulate to the truth of those underwriting questions. What is the classification? What is the exposure like? What is the catastrophe exposure? What's the quality of management? All of those other types of underwriting questions. For a property, for example, we might go out and look at what the age of that property is. We would want to know what the construction is. We would want to know what the fire protection is. All of that information is information that we can bring in from external data into the underwriting process. We might look at the crime zone or the crime metrics if we're offering theft coverage or if we're offering vandalism coverage. We would look at weather data. We would want to know whether that location is prone to hurricanes, whether it's prone to hail or tornadoes, perhaps prone to freezing, depending on the type of coverage that we're offering. We have services, for example, that give us pictures of what the roof of a location looks like. If we understand the roof and we see a picture of it, we can actually tell whether there are trees overhanging the roof. We can see what the condition of the roof is. We can see if there's any evidence of leaking or ponding of water on the roof. We can also create quantitative grades about what the quality and what the lifetime value or lifetime what the useful life is of that roof. And all of that information that can then be brought into the underwriting process and allows us to evaluate the underwriting quality of an account and also evaluate what the price should be for that account. Now, it depends how we bring in this data and how we build technology really depends on the products and the strategy of the company. There are things that technology does much better than what people can do. Let's talk about distribution. One of the important parts of a strategy that a carrier puts together is the question of how they're going to distribute their products. There are many different distribution options available. Companies can distribute through retail agents. They may distribute through wholesalers. They may distribute through MGAs or through affinity groups. In fact, there are some companies that even distribute through other insurance companies. One of the things that I really enjoy in my work is working with distributors, with producers, with agents, with brokers to understand the market and to understand their process and their pain points as they try to sell business into that market. If we understand the pain points of the producer, then we can design solutions that address those pain points. They may change how we do the underwriting. They may impact how we offer the product, or they might impact the way we engage with that producer through technology. And as we make it easier to do business with that producer, it allows the producer to write more business, and it also allows the company to be a more seamless facility for that business, creating just a much better, much more efficient partnership from the producer to the carrier, and ultimately serving the client much better. Let's talk about technology. As a company builds out its vision and its strategy, as it starts to think about how a company wants to offer underwriting services, how it wants to design its products, what distribution it wants to go to, all of those decisions and ultimately their entire value proposition is going to have to be supported and delivered through technology. And so as I work on those different attributes of the business, I also work very closely with technology folks or research and development or data folks to be able to practically build into our systems the vision that the company wants to extend out to the marketplace. Now, for existing companies, there is usually existing technology in place. There is legacy technology in place. There's business that runs through that technology. And so as we build technology, we need to think about how we integrate back into that legacy technology. And that can be difficult because as technology advances, it just gets harder and harder to integrate backwards into older and older technology. Ultimately, that business will have to be moved or conveyed onto the new technology, and companies eventually have to decommission that old technology and continue to move forward, which can be a very difficult and very expensive process. Of course, the advantage of having an existing book of business is that you can build technology while you still have business running through your platform. And of course, that means that you've got revenue coming in and you've got the ability to pay for additional investment going forward. In a startup environment where I spend a lot of my time, most of the technology, if not all of the technology, is brand new. So there is no legacy technology. There are real advantages to that because there's nothing that we need to reverse integrate into. There's nothing that we need to connect into in terms of past technology. But the downside is that we also have to build that technology and expend all of the resources for that technology before we have revenue coming in. And so all of that expense has to be invested with no revenue coming in. And we want to get to the point as soon as we can where we do have premium coming in. So the way we do that is we lay out the process from end to end, from the very beginning where business is submitted all the way to the very end where the policy is issued and where billing takes place. We look at all the steps in that process, and we look at all the information that we want to bring into that process. And then we design the behavior of the system in such a way that it will step through that process exactly the way we envision it, bringing in the information and the data, underwriting information, policy and product forms, distribution information, all the financial transactions that happen along with that, so that all of that information is brought in at the right time when it's needed in the system. Let's talk about claims. Of course, the ultimate product that an insurance company is providing, regardless of the market, regardless of the strategy that they're using to deploy that product, is the promise that they're going to pay claims when they happen. It's the security that a customer can have that if they suffer a loss, the company is going to be there for them. And technology provides the underlying support to the claim system, to being able to provide that promise. Technology needs to be able to do a variety of transactions. It needs to be able to receive, for example, a first notice that a claim has come in. It needs to be able to set reserves on those claims. It needs to be able to enable payments, to allow different investigations to take place, to capture documentation, and allow the claims handlers to be able to engage with producers and with clients in being able to settle those claims. Now, claims can take just a wide variety of formats. So, for example, property damage that takes place to an individual or to a business would be a first-party claim. And in that case, you need a claims system that is able to evaluate the damage, able to send out adjusters to review the damage themselves. In some cases, for small claims, the system may actually allow payments to be made automatically with very little claims adjuster supervision. And there may be other documentation that needs to be captured for that type of a claim in order to be able to settle it with a policyholder. In a third-party claim, that's a situation where the claim is actually not coming from the policyholder themselves, but rather it's coming from a third party making a claim against the policyholder. So in many cases, this involves litigation and liability. And so in that case, the policy or the claim system, in that case, the claim system also needs to be able to handle liability claims and all of the activity that takes place in terms of the discovery of what happened, an understanding of what happened, any types of litigation that are going on, scheduling, orders from courts, reports and engagement with various attorneys. And so the claim system really has to be very, very flexible to handle those different attributes that can take place with claims. Ultimately, the claim system also needs to be able to transfer the financial data that's taking place in that system to the financial systems of the insurance carrier so that the insurance company knows how much is being paid out, how much is in reserve and which is expected still to be paid out, and how claims are opening and closing on the books so that they can continue to grow, they can continue to manage their assets, and they can continue to provide long-term sustainable security to agents and to customers.